Hello all, this is your investments quiz review for Chapter 15. For your quiz, the first thing you are going to need to know is how to book the purchase of an equity investment. In this example, on January 1st, 2019, Wilco Industries is purchasing $50,000 worth of Wyland Inc.'s common stock. So in the journal entry to record this purchase, we're going to book the stock that we are buying under an account called equity investment. It's not common stock. Common stock represents our own company stock. So if Wilco was issuing stock, it would be common stock. But since we're buying the stock of another company, we're making an investment, we're going to record it under equity investments for the face value of what we're purchasing, which is $50,000 worth of common stock. What do you buy stock with? You buy stock with cash. So that gets credited for $50,000. And we purchased Wyland's common stock. Companies and investors alike buy stocks for two different reasons. The first is appreciation. We're hoping to buy that stock that is going to go up in price and that we can sell it later for a profit. And the other one is that periodic receipt of small payments that every investor loves called dividends. Well, that's what's happening to Wilco here. They're receiving a dividend from Wyland on July 1st, 2019 for $1,000. So to book this, we're going to record it under cash. They're paying cash for their dividends for the amount we're receiving, which is $1,000, and we're going to record that income, that money coming into us, under our dividend revenue account. So dividend revenue is credited for $1,000. We received a dividend from Wyland. When we sell this investment, like Wilco is going to do on December 1st, we need to keep in mind not just the price that we're selling it for, but the price that we paid for it. So in the journal entry, we're going to start with a debit to cash, and that is for the amount of money we are getting by selling this stock. So Wilco is selling their holdings in Wyland Inc. for $55,000, means we're getting $55,000 in cash. Next up, our equity investments have to come off the books, and we put them on the books at a certain price. Whatever price we put them on for, we have to take them off at the same price, or our debits will stop equaling our credits. So equity investments is going to come off the books at the price that we paid to buy Wyland Inc. stock in the first place, which was $50,000. We sold it for $5,000 more than we purchased it for. We're going to record that under an account called gain on investment sale for the difference between our purchase price of $50,000, our sale price of $55,000, which is $5,000. This account can also be called gain on asset disposition, gain on disposition of assets, gain on investment disposition, gain on asset sale. I've seen a million different synonyms for it. It's all the same thing. Companies just choose a different name. In your drop-down list, find the one that matches best. And how did I get that? I got that again by subtracting the sale price minus the purchase price. What we did is we sold this investment at a profit. So, equity investments on the income statement. We're going to report both the revenue from dividends and the gain from the sale of our equity investments under a section called Other Revenues and Expenses. Why don't we just throw it in revenues on the top? It's because it's important for a company to know the difference between their operating income, the amount of profit they made from their own operations, and their net income, which is the amount of money that they made from their own operations and other stuff. In this case, Wilco is not an investment firm. That's not their normal course of business to buy stock and collect dividends, etc. So they're not going to record it under their normal operating income. They are going to put it in this other revenues and expenses section. And while it's there, it will have no effect on operating income. It will have an effect on the company's net income. Another thing we can invest in is debt, which is namely the corporate bonds of other companies. That's what Wilco is doing here in this January 1st example. We are purchasing $200,000 worth of Kretz Food Incorporated's 3% 10-year bonds. So to put them on the books, we are going to record them under an account that I'm going to call HTM Debt Investment. It stands for Held to Maturity. When you put debt on the books, there's different classifications that you can put it under. It's always something debt investment. There's held to maturity debt investment. There's trading debt investments. They're available for sale debt investments. You need to have a different account for your intent with that bond, how long you think you're going to hold it for. It lets your investors know when they can expect the inflow of cash from that bond's redemption or sale. Accounting for debt investments has a ton of different rules. This is a 100 level accounting class. I don't want to overwhelm you guys, so feel free to assume that for the purpose of AC116, whenever we buy a bond, we're going to hold it until maturity, and we're going to record it as a held to maturity or HTM debt investment. We need to put that asset on the books for the price that we paid for it, which is $200,000. And again, how do we pay for it? We paid for it in cash. We purchased a Kretz food bond. On July 1st, 2019, Wilco received a semi-annual interest payment on these $200,000 worth of Kretz Food Incorporated's 3% 10-year bonds that we had purchased previously. So to fill this in, what are we receiving? Well, interest comes in the form of cash. So how much cash are we getting? Well, we can figure it out with the following calculation. We can take the face value, or the principal, if you will, of the bond, which is $200,000, multiply it by rate, which is stated as 3%, and multiply it by time. Since it's a semi-annual interest payment, that's every 6 months, so 200,000 times 0.03 times 6/12 means we're getting $3,000 in cash. When we record this revenue that we're taking in, this money that we're taking in, we can't put it under sales revenue or service revenue or even dividend revenue, because that's not the source. It's interest from bonds, so we're going to call it interest revenue, and that is going to be credited for $3,000. We received interest on our Kretz food bond. So bond interest payments, because these bonds are going to hold the same face value, the same interest percentage, and the same payment schedule, and by that I mean quarterly payments, semi-annual payments, etc., for the entirety of their lives. Once you figured out the journal entry for one receipt of interest from a bond that you've invested in, every subsequent payment that you receive from that company that you invested in is going to be booked the same exact way. None of your inputs are changing. So back it up for a second. Every single payment that Wilco receives from Kretz Foods, it's going to be the same exact entry: a debit to cash for $3,000 and a credit to interest revenue for $3,000, and we're just going to keep doing this over and over and over again every 6 months for the entire 10-year life of the bond until it matures. And when it matures, we're going to dispose of it. So let's jump forward in time. And on July 1st, 2029, we're going to dispose of this $200,000 worth of Kretz Food Incorporated's 3% 10-year bonds, because they've matured. They've reached their life. Now Kretz owes Wilco the money back that they let him borrow up front, which was the $200,000. So we're going to get cash equal to face value in exchange. How do we book it? Pretty straightforward. We're getting cash. How much cash are we getting? $200,000. What do we no longer own? We no longer own this bond that is entitled to pay us interest and a repayment of principal at the end of its life, because it is the end of its life. They are paying us off to get out of their debt to us. So we're going to take our debt investment off the books by crediting it for $200,000. We disposed of a mature Kretz bond. I wish you all the best of luck on your quiz. Email me if you have any questions. Take care.